So have you ever wondered what giant companies do with all that cash they have just sitting there? I mean, we're talking billions. Well, they definitely don't just let it collect dust in a bank account. Nope, they put it to work, playing this high-stakes game of investment. And today, we're going to open up their playbook. We'll look at the strategies, the way they keep score, and, the real power moves happening behind the scenes. All right, here's how we're going to break it all down. First, we'll get into why they even bother investing. Then, we'll look at the two big strategies they choose from. After that, we'll dive into how they actually count the money they make, or lose. And finally, I'll show you exactly where to find all this stuff in their financial reports.
Okay, first things first, let's tackle that big question. Why do companies even invest in the first place? And you'll see, it's about way more than just trying to juice up their bank balance.
Yeah, this is really the core of it, right? I mean, for a huge company, letting cash just sit there is kind of like leaving your star player on the bench during the championship game. It's just a total waste of potential. So putting that money to work, that's a critical move. And the reasons behind it can be anything from simple financial targets to some really complex corporate chess moves.
So it really boils down to three main things. First, just putting that extra cash to work to get a better return than a savings account. Second, it's about generating a steady flow of income, maybe from dividends or interest payments. And third, and this is where it gets really interesting, it's about gaining strategic influence over another company. We're talking suppliers, competitors, you name it.
All right, so this brings us to a huge fork in the road. It turns out pretty much every investment a company makes falls into one of two buckets. And which path they choose, well, that changes everything. It changes the goal, the strategy, and even how they keep the books.
Okay, so on one side, you've got companies just playing the market. The goal here is super simple: make money, purely financial. We're talking interest, dividends, selling for a profit. But the other path? That's all about building an empire. Here, making a quick buck isn't really the main point. The real goal is influence, building relationships, and yeah, ultimately, control.
So the official accountant speak for playing the market is a non-strategic investment. And honestly, the name kind of says it all, right? The main goal isn't strategy. It's just a financial return. Sometimes these are super short-term, just a place to park some extra cash. Other times, they're held longer to bring in some steady income.
And that building an empire path, the official term for that is a strategic investment. Now, here's the key difference. This is always about buying equity. We're talking shares, ownership. And why's that? Well, think about it. You can't really influence a company just by owning its bonds, by just being a lender. You need a real seat at the table, and that only comes from being an owner. This is definitely the long game.
Okay, so let's explore that first path a bit more, the whole playing the market idea. When the goal is just about making money, how do the accountants actually keep score? Well, the rules are all set up to show what's happening in real time.
And here's the main principle. For these kinds of investments, the accounting books can't just show what the company paid for something 6 months ago. That's old news. They have to show what it's worth on the market, like right now. The whole point is to give a current, up-to-date snapshot of where things stand.
The way they do this is with something called the fair value model, and it's actually pretty simple. Step 1, you write down what you paid for the investment. Easy enough. Step 2, at the end of the month or quarter, you look up its current price. Step 3, if the price changed, you update the value on your books. That difference is called an unrealized gain or loss, and unrealized just means it's on paper. You haven't actually sold anything to lock in that profit or loss yet.
Let's make this real with an example. Check out Ace Corporation. They bought some ABC shares that, on paper, lost 25 grand. Ouch. But they also bought some XYZ bonds that went up by 40 grand. So here's the important part. On their big financial report, they don't list those separately. They net them together. So Ace reports a single unrealized gain of $15,000. It shows how their whole investment portfolio is doing, not just one piece of it.
Okay, let's switch gears and go down that second road, building an empire. For these kinds of strategic investments, the day-to-day ups and downs of the stock market, that's all just noise. The accounting here couldn't care less about the daily price. It's focused on something totally different, influence.
And believe it or not, how they account for it all comes down to one single factor. What percentage of the other company's shares do you own? That one number is the key. It's the official measure of how much say you have.
So if you own less than 20%, the rule of thumb is that you have insignificant influence. Basically, you're just along for the ride, a passive investor. And because of that, they typically just use that same fair value model we just covered. The goal is still seen as mostly financial at this level.
But the moment you cross that 20% line, everything changes. Game on. If you own between 20 and 50%, you're now considered to have significant influence. You don't have total control, not yet, but you absolutely have a voice. You've got a seat at the table, and you can help shape where the company is headed.
And that level of influence means you need a whole new way of accounting for it. It's called the equity method. And the logic behind it is actually pretty cool. Think of it this way. If the company you invested in has a great, profitable year, the value of your investment on your books goes up by your slice of their profit. If they have a bad year and lose money, your investment value goes down. Your financial fates are tied together.
And finally, if you cross the 50% ownership mark, well, that's control. You're not just an influential investor anymore. You are now the parent company, and they are your subsidiary. So for accounting, that means you literally consolidate everything. It's like their finances move into your financial house. You report all of their assets, their debts, their income. Everything gets rolled up and reported as if you're one giant single entity.
Okay, so we've covered the different strategies and the accounting rules, but where can you, as someone on the outside, actually see how all these moves are playing out? Well, you just have to look at the official scorecard, the company's financial statements.
You'll find the clues scattered across two main reports. First, there's the income statement. That's where you see the results of the game, all the income from interest and dividends, plus those paper gains and losses we talked about. Then you have the statement of financial position, which you might know as the balance sheet. That's where the investments themselves are listed as assets the company owns.
So let's end with a question that's actually at the very heart of a big debate in accounting. Is it right for a company to report gains and losses that are just on paper? Or should the only thing that counts be a real transaction, when actual cash changes hands? How you answer that really changes how you see a company's performance. It makes you stop and ask, what does value even mean? It's definitely something to chew on the next time you're looking at a company's numbers.